Welcome. I'm Catherine Magana here with Vince Stefano, Steve Wolf, and Greg Carroll. And we're here today to continue the conversation. We've been talking about the markets, investing, and some planning ideas. And just to kind of kick it off, it looks like in the last few weeks, it's been interesting with the markets. And in particular, in the last week or so, it looks like there's been a shift with money flowing back into the market with some of the mega stocks, in particular technology, consumer discretion, and communications. And then obviously there's some labor reports and things that should be coming out soon. And there's obviously still talks about interest rates and pausing the rise of interest rates and potentially looking at some increases next year. So there's kind of a lot going on. And one of the things I also looked at and noticed was the volatility index is still low for the year. But I think I'll turn it over and see if anybody else wants to chime in.
One of the things that has been interesting, I don't know if you guys have been hearing the same thing. I've had at least 3 or 4 clients ask me if I think that the market is going to crash. Now, I'm not sure where that's coming from. Maybe you guys know.
I have not had that question.
Yeah, it's kind of weird. All of a sudden, I'm getting it.
Well, the talking heads on CNBC and some of the other financial news networks continue to talk about recession next year, the economy slowing down, people losing their jobs, possibly, going into a major, decline. I haven't seen it from earnings reports and stocks or stock prices or anything, but hey, that's the talking heads.
Yeah, and I haven't seen it either, but I'm gonna harp on this for as long as I can. And no one seems to be worried about the deficits that we run every year and our debt. And, it's interesting because I was just reading, first of all, a lot of people may not know the difference between the deficit and the debt, okay? Because I hear a lot of people using that interchangeably. Basically, the deficit is the amount of money that we don't have for expenditures. So on a yearly basis, you're going to collect X amount of dollars and you're going to spend X amount of dollars, whatever that is. If you don't have enough, that's a deficit. Now, how do you fund that deficit? Well, you borrow money. And that's where the debt comes from, because that goes year to year to year to year. And interestingly, I read an article from the Penn Wharton School of Business on their budget model. And they're basically saying, first of all, that $33.2 trillion number is actually not accurate, because about $6 trillion of that is actually the government owing itself. But the actual true number is about 26.3, which is trillion, which is debt held by the public. Okay. The problem is that they're estimating, and this is the Penn Wharton people, that the U.S. debt held by public cannot exceed about 200% of GDP. Even under today's favorable circumstances, and right now we're close to 100%. They're also saying we have about 20 years left before it won't matter what you do with raising taxes or trying to cut, it will be out of control, and then we will have a crash. So I wish that we would be paying way more attention to this. It's not political. It's not which party does it more or less. It's that we're doing it.
I think what we tend to see is really the now, like the impact. I think people on their individual basis look at where's inflation? What's the cost of goods? What's the cost of gas? But absolutely, I would agree that we definitely need to be thinking about our spending and what's the impact. But I do think in general, usually you hear people on an individual basis look at their own bottom line.
Okay, well, here's the funny part, all right? We think that the government's going to fix everything.
Yeah.
Why, I don't know. But I was just reading something called the Jolt Report or something, and the idea of the government fixing anything is ridiculous. Okay, so here's an example. Elon Musk with his company SpaceX, they just launched something that had never been done before. It's like 11 million pound something. I don't know what it is, but getting this huge spacecraft up in the air. And you know what the government is interested in? What's the chances of your rocket hitting a shark in the ocean? You can't make this stuff up. That's what. So that, and if it's going to disrupt seal mating. Okay, so I just read where what they did is they forced the Elon Musk company, whatever that is, to kidnap a seal and tie it to a board and put headphones on its ears and did sonic booms to see if it's going to be distressed. Well, I don't know about any of you, but if you tied me to a board and put headphones on my ears and had sonic booms, I'd be distressed. Okay, so this is what the government is worried about. And that's why it does not give me great confidence that the government is going to solve any financial problem.
Yeah, I would agree. I think that, there's a lot of divisiveness across the, our government, all the way down to your local governments from Washington on down. And it's, like the political discussion we had a little bit earlier about presidents. People are actually voting for a president because they don't want the other person. It's not who they want, it's who they don't want in office. And so, it's just, there's so much chaos and disruption in Washington. And you can watch YouTube videos every day about how these Congress people are, trying to, get their points across to some of the speakers that they bring in there for different organizations. And it's captivating. I mean, to watch how disorganized they are.
Well, I don't know much about seals, but I do want to follow. I do want to follow up on something that Catherine said. You had mentioned something about spending, consumer spending, and I was reading the San Diego Union sports pages today, and I saw that one of our best players, Juan Soto, unfortunately got traded to the Yankees, and I was thinking, well, if the billionaire Padre owners are cutting costs, what's the average person going to be doing? And I was only thinking about it because of the holiday season coming up and what retail sales may look like. Well, Hanukkah starts today, and I hope you bought something very nice for me. Hanukkah starts today. Christmas is in 2.5 weeks. And with the spiraling inflation, higher interest rates, prices up across the board, and the consumer actually being able to hold up the market for the last couple of years, I was kind of thinking, what's going to happen to retail sales? And I don't know, but retail stocks have done considerably well going into this fourth quarter. But it's kind of an anomaly because people are saying they're tightening their belts,
right?
Yet the retail stocks are doing much better. So it's kind of interesting there where you're seeing that, just that little interesting flip that I'm seeing. I don't know. I don't know what the consumer is going to do, but I think they're going to do okay.
Well, most of what I'm reading is that everything is slowing down now. Okay, that's why the Fed has stopped. It looks like anyway they've stopped raising rates. It's possible they could go another 1/4 point, but probably not. So it looks like over the next year or so, you can expect, I am expecting anyway, that the consumer is slowing down. The economy is slowing down. I think what people are doing, though, is they're borrowing more money. Again, they're using their credit cards more than they used to. It's not a good thing. Okay, again, it's how much can you afford to actually spend?
So it's interesting. I was kind of looking back to see where inflation was last year. In October of last year, it was at 7.7%. In October of this year, 2023, it was at 3.2. So that's a big change in a year. But we're also now seeing interest rates. I mean, on the shorter end of the curve, we've seen a pretty decent yield. And then I'm starting to see rates come down a little bit.
Well, when you go from almost 0% interest to 5.5% interest, it has a profound effect on slowing things.
Absolutely.
And also the cumulative effect of being 7.9% a year ago and 3 and change. Prices are still going up. You go to dinner, you go to the grocery store, the prices are pretty high.
When you factor in kind of wages and all that, because a lot of that has changed too.
Yeah, the minimum wages are going way up. I mean, these prices aren't going to come down for your food and entertainment.
That's true. A lot of these commodity prices are still up 25% to 30%, and they're staying there. They're not coming down.
They're going to be sticky.
We have noticed a little bit. The food prices have come down a little bit. They are starting to come down a little bit. But you know what? Those increases in the price that you pay, they're not coming down.
They're not coming down.
So if you're going to your local fast food company, whoever it might be, and you used to pay $8 for a burger, fries, and a drink, and you're now paying $12, even if their food price is coming down, they are not lowering those prices. And part of it is what you said too before, is that in addition to food prices, labor costs is up and transportation costs have been up. But oil is now down to what, about $70 a barrel, something like that. At one time, I don't remember the high.
Close to 100.
Yeah, and that was about a year ago, right?
Yeah.
Okay, so that had something to do with what. Certainly had something to do with it.
But it does show that the overall economies of the world are slowing because the demand for oil and energy has slowed.
So it sounds like people think, oh God, you're doom and gloom. Actually, I'm not, and I'll tell you why. Because AI is changing everything. It really is. Artificial intelligence is to this generation what the internet was to the 1990s.
Sure.
So I think that's one of the reasons why I don't see a crash coming, not in the near future. You've got huge explosive growth in AI-related businesses. Now how they monitor or how they monetize, that growth is something else. But every single business that you can think of is going to be affected by AI.
So that kind of leads to then there's also lagging sectors. There's some sectors that are a little more emerging and in growth. And so
That are lagging?
yeah, you have some sectors that are lagging. So like healthcare, utilities, but that changes. You have things that are more in favor, but right now it seems like technology's definitely been moving the market.
Well, we keep waiting for value stocks to outperform growth stocks. In the very near future, I just don't see that happening. Even though I believe that as interest rates do come down, and they probably will at some point, value stocks will be a better buy. Again, with the growth of AI, that is where your big growth is going to happen. Now there's more risk in that, of course, or with more reward comes more risk, so you could lose. But that is definitely the area, I think. And
No, I
Vince,
agree.
this is your area.
I agree. And I also think what you mentioned about value stocks, most of the value stocks are dividend players. And for a number of years, they looked good because interest rates were at 0.1%.
Right.
And so the correlation between a dividend and the yield on the 10-year or the 2-year Treasury bond, was in favor of the dividend payers. Well, that changed when the Fed hiked interest rates for 22 straight months. However, if rates do come down, the correlation will look a little better. And, those people that want value names, you may see some increase in the value stocks. However, I agree that growth is where it's going to be for the next 18 to 24 months. You just can't get away from it because as economies slow, those companies that have a service or a product that they can sell to an expanding marketplace, they're going to drive revenue, margins, and earnings. And that's where you want to be. You don't want to be in cement companies.
Although cement companies may do well if the infrastructure does well. I'm not sure that's the best example I've ever heard, but there are some companies you don't want to be
cement
in.
companies are still not growth. That's what I'm saying. They're not growth companies.
But when you look at construction and housing, the builders are doing fantastic, and we are short housing. So, there might be the materials could do
They could.
okay. Yeah.
No, I heard something today about millennials very concerned about not being able to afford the house that they want to afford. And, you had mentioned something earlier, I think, about housing and interest rates. And I think that fits right into what the millennials are thinking. And as, older people begin to pass away and leave money to their kids, they're hoping they have enough money to buy a house. Mm-hmm. It's scary.
Yeah.
So I know we talked a little bit about value and growth stocks and interest rates, and once again, being the planners that we are, everybody has a unique kind of need and asset allocation based on what's the purpose of the money and why, and that we obviously have different investments for our clients, and happy to review that over time. But I thought I'd take a moment and share just a couple of things that have surfaced over the last few weeks in some conversations. I've been asked recently a lot about beneficiaries, primary contingent, in particular contingent beneficiaries, which is something, you have something in place as something happens to the primary, then you have a contingent beneficiary. So that is definitely a planning thing to have in place, is making sure you're looking at your estate. Have you looked at your wills and your trust and your powers of attorney, and making sure everything's set up properly. We're also having some conversations about Roth conversions. Now, I know we're approaching the end of the year. It's not meant for everybody, but if you did need to do something in that regard, definitely now is the time. Or also we're also looking at for next year and doing some pre-planning for next year with some Roth conversions. So those are just a couple of things that have surfaced with some of the conversations we've had the last few weeks.
I'll tell you, the other thing that we didn't talk about was bonds. Mm-hmm. And actually, if interest rates come down, bonds will have a positive return. So, if you can get 5.5% right now in a Treasury bill, which I think you can, that's not a bad yield at all. So especially if you're in a bond fund and interest rates start coming down, the chances are that those bonds will increase in value. So there's nothing certainly wrong with bonds. And just piggybacking a little bit on what you said, Catherine, what we talk about here is not meant as advice for any particular person.
Correct.
Okay, this is just generalities.
Yeah.
Anything that you want to know about that's individual to you, you need to talk to someone. Talk to a financial advisor, talk to us, but it's not meant to be, this is what you have to do right now. So when we talk about AI stocks, and I can just hear people say, okay, I want to buy every AI stock out there. All right, well, that's not what this is meant for. Okay. Well, unless anyone else has something to add, I think that's probably going to be a wrap for this week. Appreciate everybody out there listening to us, and we'll see you next time.
Great. Thank you.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Weezy Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.